This is the show where I analyze stocks that are interesting. I'm your host, Michael Duke, and today we're going to be talking about Hershey, company that we have covered extensively on the channel, or at least multiple times. Company that I made a significant bet on, over 5% of the entire portfolio into this one stock. And today I decided to sell it. Yes, I decided to exit Hershey stock, and I'm going to explain why. Today they released their earnings. Okay, so as I've done in really my last 7 or 8 videos, we're going to be taking a look at the earnings, and I am going to explain why I no longer like the risk reward on the stock for really for the foreseeable future here. While I still believe in the brands and I still really like the business, I have a very, very strong conviction now that it will underperform the market. And furthermore, it will underperform other consumer staples stocks. So, first off, let's just take a look at the press release here. Today being the 1st of May, this is their earnings report for the quarter ending March 30th. Outgoing CEO Michelle Buck says, I am, quote, I am pleased with the progress we are making on our key strategic initiatives for the year. Consumption in the quarter exceeded our expectations in both U.S. candy, mint, and gum and salty snacks, driven by the strength of seasons. Despite heightened cost pressure, our strong balance sheet gives us flexibility to invest in the business, participate in recent strategic acquisitions that further expand our better-for-you portfolio and drive long-term value creation. For the first quarter, net sales of $2.8 billion, a decrease of 13.8%. Organic constant currency net sales decreased 13.2%. The idea behind this stock originally, when I first started accumulating shares last year, the original thesis here is very simple, that commodities are cyclical, and when there is a huge bull market in a particular commodity, in this case, cocoa, what goes up must come down. Commodities are exactly that. There's no moat around a commodity, right? It's subject to price. The producers of it don't have pricing power. They're price takers. So the price goes way up. It's a supply-demand imbalance. And eventually there's enough supply that floods the market and it comes back down. What does that mean for a stock like Hershey? What it means to me as the investor is what I want to see is I want to see there be that it only bleeds through in the cost side. But what we're seeing here, that sales, that revenue is decreasing meaningfully. That is not good. That is very concerning. Okay. Okay, let's move on. Reported net income of $224.2 million, or $1.10 per share diluted, a decrease of 72%. I think this is a good time to highlight here their dividend. In fact, here they declared a dividend $1.37 a share. So their GAAP earnings do not cover the dividend. Okay, I can't be logically consistent and on the one hand say that Nike is a dumpster fire stock that is a sell and not have the same opinion about Hershey when the GAAP earnings do not cover the dividend. Okay, that's not the only reason here. All right, but that is atrocious. Okay. However, adjusted earnings per share, which includes hedging costs or hedging gains or losses, among other things, 2.09. So enough there. However, that was a 32% decrease. Oh, that hurts. That hurts. Now, I will also say that that's within their guidance as we see here, they're reiterating their full year guidance. They've been guiding to earnings per share, both GAAP and non-GAAP, to be down. This is high 40% range, mid 30% range here, but net sales growth of at least 2%. So what's going on here? Again, this is just a quarter, but the only thing that's in line with this guidance in this quarterly result is adjusted earnings per share being in the 30s. Everything else is much worse than their guidance. Of course, as we see in their quarterly financials, their numbers are like this, right? So, don't want to read too much into that data, but it's tough to look at their guidance being 2% revenue growth, where they're reporting for the quarter, near 14% and 13% in dollars. That's tough to swallow, given what this business should be. It's a staple stock. I get it that chocolate, confectionery, and the like is a little bit more discretionary. Excuse me, a little bit more discretionary than other staples like tobacco and the like. But I would expect, in a very simplified sense, for staple stocks to not have sharp decreases in sales year over year. So while I would expect their profit numbers to be meaningfully lower due to commodity inflation, sales, that's different. Now, one thing to consider here is I don't believe that they missed on revenue. They were guiding to, or analysts were expecting 2.79 billion. So they did beat on top and bottom line. So very low expectations for the quarter. So I don't want to say that the revenue is catching me by surprise, but let's keep going. This is where we start to get to the meat and bones of the deal here. Okay, tariff expense, as understood today, to be approximately 15 to 20 million in the second quarter. Again, when we have a net income on a GAAP basis of 200 something odd million, close to 10%, less than 10%. I mean, that's not necessarily surprising given the fact that we've slapped these blanket tariffs on the world. That shouldn't be surprising, but having it spelled out here, I guess, gives it a little bit more perspective, right? A reported and adjusted effective tax rate, 16%, reflecting the changing global business and tax landscape. I believe that that's lower. Other expense, which primarily reflects the write-down of equity investments, qualify for a tax credit, 170 to 180 million. Again, this is guidance. Interest expense. Oh, sorry. This is, that's quarterly. Sorry. Brain fart. Interest expense, reflecting interest rates on our recent note issuance. CapEx of 425 to 450 million, and then really, we can call that this cost mitigation here, advancing agility and automation initiative savings. So, this is their projected full year guidance here, okay, versus what they did last year. So their reported EPS, which again I keep referring to as GAAP, I believe that that's what we're doing here, 555 to 587. They are not guiding to their hedging, any sort of hedging losses here, okay? Whereas they did experience that in the prior year, and accreting some EPS from business realignment and acquisition and integration related activities. If we remember, recently they acquired Sour Strips for $100 million, I believe, and then they are currently working on an acquisition of Lesser Evil. So I'm not much of a candy person, however, Lesser Evil I do really enjoy. But just taking a look at this from here to here, that is a lot. That's 40 something odd percent at that low band. 40 something odd percent decrease. So what we're seeing now is with the cocoa inflation, with the cocoa costs, companies like this they purchase enough of that inventory. They have enough. They use derivatives to either purchase their inventory of the cocoa input, among other things, sugar, all that. They'll use the derivative market to hedge and purchase, and then they would have stocked up on cocoa, ideally at lower prices. But just because the cocoa price went up by 5x like it did, it doesn't mean that hit their margins initially. It takes a couple years for that to bleed through into the financials. This is the year, particularly the last few quarters, this is when it's starting to hit. So what does that tell us? It tells us that the inflation in cocoa prices is more prolonged than their ability to effectively hedge it has been at this point. And while that's not unexpected, it certainly is hard to swallow. We see here, roughly 30, their earnings per share on a diluted basis down by a third from the prior year. A year, mind you, in which they had very, very poor stock performance. Okay, we look at 2024, earnings per share steadily been going up, but just to give you an idea, they're essentially guiding to an earnings per share that is 2019, 2018 pre-COVID levels of earnings. Okay, that is significant because their earnings per share has effectively doubled in that time. So we are all the way back. Okay, while the thesis is still intact of cocoa inflation dropping and all of that accreting to the bottom line, I'm going to discuss why I'm getting more bearish on the time window for that, and also the fact that the tariff disruption is creating a whole other set of issues here. Okay, so these numbers, while they are not outside of what the company has guided to, and of course they beat expectations for the quarter, I think it goes without saying that these numbers look dreadful, especially when you have the stock currently trading at a 3 something odd percent yield, and one of our other favorites, if not our most favorite, Philip Morris, which has been a huge winner for me in the portfolio. We're up almost 50% on our cost basis there, where that company is trading at roughly the same yield, but a lower price earnings ratio in the forward, and has double-digit earnings per share growth expectations in the go forward. Okay, so this is a story of relative valuation and relative momentum as well. Okay, so now I'm going to need to zoom out a little bit here. Let's just take a look here. So our again, these are sales. Okay, 15% drop in North America confectionery. Again, foreign currency exchange, FX, is not that meaningful on the overall magnitude of the business because it's mostly in North America. That was one of the things that I really that I still do like about the stock. However, for the purposes of where we are now, where the dollar has weakened by 10-ish percent over the recent months due to the tariff war volatility, that has flipped to a headwind, not a tailwind for the stock. So North America confectionery, 15% decrease. Here's the thing. It's volume. It's volume that's driving this. So even though we have less volume, we continue to increase price. And while I don't necessarily, I don't want to say that I am confounded by that. That's not a good trend, because when we're having our margins impacted, so we continue to increase prices, but we're running into a a very fatigued consumer over the last few years that's tired of the inflation and tired of all the price increases and tired of all that. We continue to increase price, and we're seeing huge volume, huge volume decreases there. Whereas in salty snacks, we have a increase in sales and we have price decreases and volumes going up. I would rather see that. Okay, so the fact that we see the inverse of that in our confectionery segment, I find particularly disconcerting. So what we're seeing here, we saw Pepsi stock trade as just keeps hitting new lows, despite a string of really good acquisitions. um, Hershey continues to make what I believe is good acquisitions as well. However, I really, really, really don't like the what I'm seeing with prices going up and volumes going down over the largest segments. So again, the salty snacks segment is a huge growth driver in the future, and the numbers look better there, but still a small piece of the pie. So these numbers here um, are not good for me. Not good. Right here. Look at this. Gross margins. One thing that we discussed in our initial video was the that a big piece of confidence that we derive when a business is seeing margin pressure, that they still have the ability to retain their pricing power due to wide moats in their segment. And that was a piece that we saw here. So we should expect gross margins to be lower. Um, and gross margins have been coming down. Gross margins have been coming down. We knew that. That's not a surprise. However, the fact that I'm trying to think of how to describe this. I think the best way I would describe it is it's a wide moat business that is it's tapping up to the limits, the upper bound of the elastic. They're really testing the elasticity, the price elasticity of their products, and increasing price by 3%, but seeing volumes decline by high teens percent over the comparable quarter. I assume that this is over the prior year quarter. Do we have quarterly financials? No, we don't have those. Talking about gross margins. Reported gross margin 33.7%, down from 51.5% in the first quarter of the prior year, 1,780 basis points, um, driven by derivative mark-to-market losses. So in other words, their derivative mark-to-market flowing through to gross margins. Higher commodity and manufacturing costs, unfavorable mix, and lower sales volumes have more than offset net price realization, supply chain productivity, transformation program net savings. Adjusted gross margin was 41.2% in the first quarter, decrease of 370 basis points. So I believe I'm not exactly sure just by looking at this the difference between reported and adjusted. It might just be the derivative piece. We'll come back to that. But either way, a decrease of 18 points and 4 points there in gross margins. It's worse than I would have liked to see this far into the trade. Advertising related consumer marketing expenses decreased 14.2%. So they pulled back on marketing. I think that the management of this company is very competent and very good, from what I can tell. However, I think that they're just in a really, really tough spot with what they're dealing with here. I think that goes without saying. First quarter 2025 reported operating profit 369.2 million. operating profit. That's what we've got here. So you can see how there's some volatility quarter over quarter. I'm not sure if that corresponds to what the equivalent of earnings from continuing operations or operating income is, but either way, meaningfully lower than the prior year. Resulting in a reported operating profit margin of 13.2%, a decrease of 1,930 basis. That's so many basis points, 19.3%. This decrease was driven by derivative mark-to-market losses. Is it gross margins or is it net margins that those flow through to? Don't let my lack of understanding by looking at this though dissuade from the ability to treat out this information. I'm just looking at this. Adjusted operating profit of $608.1 million decreased 29.4% versus the first quarter of the prior year, resulted in an adjusted operating profit margin of 21.7%, decline of 480 basis points, driven by higher commodity and manufacturing costs, partially offset by net price realization. So my read there is they're not pulling back on marketing spend because they want to, they're pulling back because they have to. The reported effective tax rate was 30.7%, an increase, again, of 11.6%. That was driven by a decrease in renewable energy tax credits and foreign rate differentials related to business strategies. The adjusted effective tax rate was 24.4%, an increase of 400 basis points. Again, driven by a decrease in renewable energy tax credits. The first quarter results, as prepared in accordance with GAAP, included items positively impacting comparability. $238.9 million or 99 cents per share diluted. So you can see here in the prior year quarter, they had a mark-to-market gain, $218 million on derivatives. So in that quarter, we saw cocoa going up. They had hedged against that and were able to profit off of it. But now the price of cocoa has remained elevated long enough that their ability to do so is becoming more muted over time. They say it's impacting their ability, so these are the adjustments. North America confectionery, $2.3 billion, a decrease of 15%. This is the table we saw up there. So we see this Hershey's U.S. candy, mint, and gum retail takeaway in the multi-outlet plus convenience store channels decreased 4.2%, reflecting the later Easter 2025. For this period, Hershey's CMG or candy, mint, and gum share declined 44 basis points compared to the prior year. These results were slightly ahead of expectations, driven by strong seasonal consumption. So market share declined slightly. Not what we want to see. However, they, I guess, expected worse. Net sales decreased 15.2% as volume headwinds, approximately 18 points, driven by the lack of planned inventory increases ahead of the ERP system implementation, the timing of the Easter season, and 2 fewer shipping days. This volume impact was only partially offset by price realization, approximately 3 points. So a little bit of context there as to the volume decrease in that they had less inventory on the shelves due to an ERP implementation. Seems to be that there's a lot of troubles with these ERP transfers. A notable example is Lamb Weston, the company that sells the frozen potato products. They famously 2 or 3 quarters ago, their stock dropped 30% or something because they screwed up the ERP implementation. ERP stands for Enterprise Resource Planning, I believe. It's a inventory tracking system, I believe. It's basically software. We see that there's been several notable examples of a company switching from one ERP to another and it causing tracking issues. So I guess that's a positive to know, a light positive to know that they did plan on lower volumes. However, that doesn't necessarily make me as a investor more comfortable about it. Um, that's just more of the same. Salty snacks up 1%, volume increased by 4 points, offset by a 3-point net price decline, reflecting costs related to selling in new skinny pop packaging. U.S. salty snack retail takeaway increased 9.6%. And skinny pop ready to eat popcorn takeaway increased 6.4%. Dot's homestyle pretzels, which are delicious, by the way, retail sales increased 21% for this period, resulting in a 337 basis point pretzel category share gain. That's good. That's good news. North America salty snack segment income, $41.9 million, increase of 8.1%. Segment margin. So again, salty snacks continue to be a bright spot. Salty snacks are still small relative to confectionery. And then the international segment, $227.5 million in sales. Constant currency net sales decreased, so still a stronger dollar environment. I do expect, in line with other things that I've discussed, that will flip to become a tailwind, not a headwind in the prior or the subsequent quarter. Hershey's unallocated corporate expense, $158.8 million, lower compensation and benefits, reduced technology investments related to the upgrade of the company's ERP. So this is reconciliation of non-GAAP financial measures. So in the prior quarter here, you had 1.7 of gross profit. This is a reconciliation, so this is after these mark-to-market derivatives are netted out. So again, this is our gross profit. You see the difference there. It's a huge difference, and derivatives really making a meaningful material impact to the gross profit. So this is our adjusted number here, our adjusted, the difference between $1 a share and $2 a share is what we're looking at between here and here. And sorry, not earnings per share because it's gross profit, but you understand. Reported operating profit, again, you see the very, very stark differences there. Again, the derivatives are the story. Derivatives are the story there, and that's visualized here, where these are our reported earnings per share, our GAAP earnings per share, again, not enough to cover the dividend, the core business activity, not their financial hedging, not generating enough profits. Again, you see the stark differences, the gross margins. Non-GAAP looks much better. And that's huge. Operating profit margin, huge difference. They had higher taxes and less profits. Now, they did guide to a much lower effective tax rate than even this for the upcoming year. So you see here, sales down and COGS up. Sales down, 400 and almost 450 million sales down over the piece, 15%-ish, whereas our COGS are up 300 million, roughly 20%, almost 20%. Very, very sharp decrease there. So whereas our net income per share, $4 on a basic non-diluted basis, all the way down to $1.14. But what I'm starting to see here is that my idea, my thesis here behind the investment, it's going to take longer than I thought for the thesis to materialize, and there will be more volatility along the way than I expected. And that is the basis of the sell. So now, let's take a look at this. It's a AI generated summary of the earnings call insights. CEO Michelle Buck highlighted the company's focus on mitigating tariff impacts, particularly on cocoa and Canadian retaliatory tariffs, which could result in an unmitigated impact of up to $100 million per quarter in Q3 and Q4. Efforts include lobbying, sourcing changes, productivity initiatives, and pricing adjustments. That's really tough to swallow. Again, we did not have this issue uh, when we started accumulating the shares, right? It was just the price of cocoa, a very straightforward investment thesis. Now, by the time I started publicly covering the stock in November, um, or maybe it was the tail end of October, that was right after the election. Um, and of course, Trump ran on this campaign where he was to implement tariffs. However, we know significantly more now about what that looks like, and now it's filtering its way through into the earnings calls. So, $100 million per quarter, unmitigated impact. That is a lot because, again, if we look at their numbers here, their income before taxes in this quarter, 323 million. So put 100 million, take another 100 million away from that, and that puts into context how big that is. That's roughly a 10% of steady state net income. That's a third of income before taxes in the prior quarter. That is a lot. That is a big impact. The CFO noted that the upcoming quarter the earnings per share expected to decline by less than Q1 due to seasonal factors, like the aforementioned Easter timing and ERP reversals. Also stated that gross margins are anticipated to decline by approximately 700 basis points, driven by tariffs and SG&A increases. So I will be honest with my viewers here. You cannot grow cocoa in the United States unless it's in a greenhouse. But think about the costs associated with building out that capacity. Right? And think about the capex required. We know that it was tariff sensitive depending on where those tariffs were going to apply to. Now we are being led by management. Gross margins are anticipated to decline by a further 700 basis points, driven by tariffs and SG&A increases. So they expect to put more money into marketing to conceivably get back some of those share gains that they lost in the prior quarter. That's really tough. They emphasize the strength of seasonal chocolate performance. Detailed robust innovation plans for the Reese's brand later this year. Expects earnings per share for the first half to decline by about 30%. Again, tariffs and cost pressures. What I was saying earlier is what I have to be honest about is these tariff impacts are significantly steeper than I had calculated. Significantly steeper. Management expects earnings per share for the first half. We just read that. Despite the challenges, Hershey maintains a path to balanced earnings growth in 2026. So while I did sell the shares in my core portfolio strategy, I still have a pretty large allocation in the IRA, and this is the number one stock in my 1-year-old daughter's stock portfolio here. Because who doesn't love? So again, Hershey maintains a path to balanced earning growth in 2026. This company's been around for a long time. There was a similar inflation shock in the 70s, of course. They've obviously been fine over that time. But what we're being told here by management is very severe. You have what's impacting the thesis and changing it is that um, the tariffs are introducing both level of uncertainty, true further gross margin compression, and volatility in supply chains. That recently I just made a video about Corteva. I realized I was pronouncing it Corteva. It's Corteva, where I actually think that despite there being strong deflationary pressure, which could be a tailwind to Hershey, deflation in the cocoa price. Don't want to discount that this might be a good deflation stock. That despite there being an initial strong deflation shock that we're facing here with these tariffs, that ultimately the supply chain disruption could create lots of volatility and shortages among different goods. There's a lot of uncertainty there that has changed the thesis in Hershey. So furthermore, if we back out of the summary, we just go to the raw transcript here. Is there a rough way for investors to think about the risk ahead if an exemption doesn't immediately come through? Steve, you want to take that one? Yes, you bet. Thanks for the question. So for the second quarter, I'd say we have enough clarity that you're at 15 to 20 as you expect. 15 to 20 being 15 to 20 million. Like we discussed, we've got a lot of inventories. So that mitigates some of the impact for Q2. As we look to the back half, as you said, I'll start by saying it changes constantly. But if we look at the unmitigated impact, and of course we are going to mitigate it, we'll talk more about that in a minute. But the unmitigated impact could be up to 100 million per quarter for quarter 3 and quarter 4. If you break that down, 2/3 of it are either cocoa or the Canadian retaliatory tariffs. And those are the two areas where, as you can imagine, we've got the most effort focused on influencing government action, using every lever at our disposal to get those tariffs changed, particularly with respect to cocoa. That's the impact of unmitigated. And as we've talked about in the past, that we're going to use aside from the lobbying and the influencing and so forth, we're going to use every lever in the toolbox for whatever amount of tariffs remain as we go forward. And we'll be in a position to share more specifics about those actions and kind of get back to mid-year mark. But as we've said before, like all of the levers are on the table, so we look at mitigating both the cocoa and incremental tariff component. That's a challenging situation for sure. But he says we still see a path to earnings growth next year, even with tariffs as we currently understand. Now I'll say the next breath, that path is narrower. It's more challenging and it's going to point to the importance of the mitigation of the actions we're going to take as we get further into this year, but we still see a path to earnings growth. I still like the stock from the standpoint of when the tide turns again, when the momentum returns, I really like it. But what's happening now, particularly with the tariffs, it's kicking the timeline for the trade out. And in this game, if you're trying to outperform, like I am, if you're trying to outperform, being too early is the same as being wrong. So there might be some rounding involved with this question, but at the midpoint, your guidance seems to apply pre-considering tariffs. Your expectation for EBITDA has gone up modestly. So if that's correct, just any factors you're seeing that have made you a bit more optimistic on the base business, or really is there just some rounding going on in terms of what we might be seeing in the guidance? It is really rounding. Steve says, fundamentally, we're still aligned with the outlook. Not sure if that's material to our analysis here. Megan Clapp with Morgan Stanley says, if we were to put tariffs aside, I just wanted to maybe take your pulse on whether or not if we put tariffs aside, you would have felt better about the ability to grow earnings per share next year. And I guess I asked because in the prepared remarks, cocoa is still high, but it has retreated, which is true. It was 12,000, it's 8,000 something today. Doesn't seem like your stance on the outlook for cocoa prices has changed at all. And Michelle, I think you did mention elasticities have been a lot better than the -1 you were assuming in the guide. So if we were to put tariffs aside again, I know it's challenging and who knows what will happen. But I guess in the base business, do you feel better about the ability to grow earnings in the base business absent tariffs? It definitely feels better without tariffs. So I say that unequivocally. Do we still see a path through? Still see a path though and feel a level of confidence about a path to earnings growth. If you take tariffs to the side with the base business, I think yes, based on where cocoa prices are today, and again, it's going to require some aggressive action. We'll talk more about that as we get further in the year. But from a base business standpoint, our view hasn't changed. The 100 million that you cited unmitigated, does that assume that we, for cocoa in particular, does that assume that we stay at that 10% pause tariff rate? Yes, it does. So at 10% tariffs on the countries we're importing cocoa from is the 100 million. That is a lot. That is a lot. Okay. So the tariffs are really changing the thesis. We did not have in the prior quarter earnings, we did not have the information required to calculate that and know that. But now we do. And even though it's still a work in progress on tariffs, I think it goes without saying that the tariffs are adding another dimension of pain here to the stock, and that's really what is changing things. I think I've said that a million times, and I'll say it again. So, lastly, I just want to talk about the technical analysis. Um, One thing is in this range here, where 180 was our support and 200 effectively served as our resistance here. The stock sold way off and it was bouncing along here. I accumulated the shares through this range. Well, what happened is we broke down below that, and despite this one spike above 200 temporarily, in which there was a uh, rumor that Mondelez was going to acquire Hershey, the stock shot up, but quickly sold back down, and actually sold all the way down to 140-ish a share. Um, so I think technically what we're looking at is also contributing to a change in the baseline here, where now we have broken down into a new channel here, where the 150 is our new support, and the 180-ish line is our resistance. So, we're back to this range that we saw 2021, 2022 before we broke out. So, technically, the stock has broken down. And I've held it all throughout this to today. Um, but what I'm looking at now is that the 150-ish and 140s area now is more of the accumulation zone, I would say. So I think just narrative-wise, sentiment-wise, more trouble here with the tariffs, but also the chart has gotten worse. And we did discuss that in our prior video. We were up around this range here, I believe, the last time we talked, still in here, but now since that time, since we made the last video, I believe we have bounced back down off of that resistance line. So it does, while that's not necessarily a confirmation that we're in a new range, I think it's pretty right to assume that we are. So from a technical perspective, we're down meaningfully on our cost basis into a whole other territory, and I just did not believe that now was the time to double down. However, I will qualify all of this by saying that I still very much do like the prospect of this company and see a bright future. But there's too much uncertainty right now. The margin erosion story is just getting worse and worse um, on days where, let's just take a look here at the price. Margin erosion story continues to get worse, and the tariffs are contributing to that. Here's our cocoa price. Pretty bullish looking chart. It's currently in a long-term uptrend here, or at least a since 2024 uptrend, notwithstanding this area here, right? But it's definitely meaningfully held this level. We're at the lower end of this, and of course we're meaningfully higher than the 25. I believe this is per ton, 2,500 per ton area. So this doesn't look good. If this were a stock, would you feel like it was in a bull market? I certainly would, feel comfortable buying it here along this lows in this uptrend. So we have multiple very, very strong headwinds working against us here, and that's changed the outlook, I think, for the time being. So I'm officially here changing my mind on the stock. I do not like it right now. The duration of my main portfolio is shorter than my retirement accounts and my daughter's account and everything. And I think continuing to accumulate shares is one thing, but for the purposes of this, where I am publicly displaying my returns, my results, where I'm trying to outperform the market with my strategy, I do not believe that we see superior risk-adjusted returns versus the index, versus the benchmark here. So for that reason, I'm out for now. And that's certainly not a recommendation to anybody here. It's just my personal opinion. I urge you, please, as always, to do your own research. But that'll conclude the video for today. Hopefully you found this helpful, instructive, and interesting to your own investing efforts and general curiosity with financial markets. As always, I'm Michael Duke. It's been a pleasure serving you with this analysis today. And thank you to my viewers. We are now over 300 subscribers. We are moving up in the world. So until next time, I will sign off now. I'll see you later. All right. Thank you for watching.